Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Glenn Mueller. Thanks for being on the show, Glenn.
Thank you.
I'm honored to have Glenn on the show, and a little about him. He has 44 years of real estate industry experience, including 36 years of research. He is internationally known for his market cycle research on income-producing real estate, his real estate securities analysis or research, and his public and private market investment strategies and capital market analysis. He is a professor at the University of Denver's F.L. Burns School of Real Estate and Construction Management, and is also a real estate investment strategist at the Black Creek Group. So, Glenn, thank you again. I'm honored to have you on the show, and I'm really looking forward to this. I know this is going to be a popular show, and I want to tell the listeners ahead of time, too, that Glenn's even going to share his screen with us so we can see some slides that he's going to explain. But we're going to try to explain it in a way where if you can't see the screen, you can also gather lots of great information. But, Glenn, tell the listeners maybe a little more about yourself or what your focus is right now and or anything I didn't cover in your bio, and let's jump right in.
Sure. Well, my experience comes from being a bank loan analyst, from being a builder and developer myself. I'm actually building my son's office building right now in St. Paul, Minnesota, and it's building number 58 in my career. I've worked for a lot of big institutional investment firms as a real estate investment strategist, and currently with Black Creek Group, and we're actually closing our fourth industrial fund. Today we sold it to Prologis for $4.4 billion. And so,
with a B, right?
I've been doing my real estate market cycle research, which helps us determine where to invest around the country for a long time, and teach that at the University of Denver, where we got both undergraduate, graduate, and executive real estate programs. So, it's something that's widely used throughout the real estate industry, and investors are interested in it as well. So I'm going to now flip to here and share my screen so that I can show just a couple of graphics that should help with what's going on. So Whitney, let me ask if you can see that okay. What I have up is...
I can't see it yet.
Okay, it's showing on my screen, not on yours though, huh?
There'll be a button for you to share it, or it's going to come up, mask what screen.
Let me go backwards here. I'm going to hit share. I'm sorry. There we go. Now let's try it. Can you?
Perfect.
Can you
yes, got it.
Yeah. Okay. Great. Fantastic. So, real estate is honestly fairly simple. It's a delayed mirror of the economy. And I'm talking here about commercial income producing real estate, not home ownership. Okay. Home ownership is really a production process. If you wanted to invest in that, you'd buy a home builder stock. If you're buying income producing real estate, 5 major property types: office, industrial, retail, apartments, and hotels. We look at the basic things that drive that. One is GDP growth, obviously, which is the production of the U.S. economy. The top graph shows you that GDP growth since the Great Recession ended in 2010 has been averaging around 2%, forecasted to slow down just a little bit in the next year or two, which may or may not happen. That's a guess on the part of economists. But what really drives demand for real estate is employment growth. And you can see there again, a kind of 2% employment growth that's been going on since the Great Recession as well, starting to slow and supposedly coming to a bottom close to zero in 2021. But that's really a statistical deal because of more baby boomers like me hitting retirement age than millennials coming out of school and going into the workforce. But that assumed when this was put together by Congress that people would retire at 65. And of course, that is not the case in many cases. A lot of baby boomers continue to work, or they stop their current job and do something else in retirement. So it may not slow down that much, but that growth, every time a new person is employed, we need more real estate for them to work in, for them to shop in, and do other things. So I look at demand from employment growth, and I look at supply or new construction of real estate coming along. And the cost of new construction has been high. Finding construction workers has been difficult. So we've had a moderate 2% or less growth in most of the property types and most of the markets around the country as well, so that we have a balance. If supply and demand are growing at similar rates, we're in an equilibrium state. And my market cycle report, and here I've got the major property types, you can see 4 parts to that cycle: a recovery, an expansion, a hypersupply, and a recession phase. And this is, in essence, an occupancy cycle. Occupancies are low at 0.1. They're at their long-term average at 0.6 and 14. They are at peak at 0.11, but that's also a point where demand and supply are in balance. So just because we're at a peak, we could actually sit at equilibrium for a long period of time, potentially going forward. And as you can see, all of the property types today are in the expansionary phase, except for apartments. And it's not because demand is slowing down in apartments. We actually have very good demand in apartments from these millennials coming out of school, both high school and college. But we're building just a little bit too much at the moment. And if we can slow down new apartment construction by as little as 10%, apartment would move back to that peak equilibrium occupancy level at 0.11. So let's just look at the different property types and what's happened over time. The blue line on this graph shows you occupancies, a peak way back in the early 1980s, a bottom with the recession of the 1990-1991, a peak in 2000 with the technology boom that was happening, a bottom in 2002 when that tech bubble burst, another peak lower than previous ones in 2006 and 7, and then, of course, a bottom during the Great Recession of 2009 into the beginning of 2010. A fairly long recovery period and back up into the growth phase by 2016. And we're sitting at that kind of lower peak equilibrium level in occupancies for office space for the past few years. And I forecast that that's going to continue for a couple of years going forward here. The other line, the gray line, is the rental growth. And you can see that rent growth very closely follows occupancy levels, and the correlation is actually 79%. You can see that rent growth over that time period has gone up 52%, so that's both the positives and the negatives added together. And you'll see that right now we're looking at rent growth that should average in the 3 to 4% range, which is just at or a little bit above inflation. So each quarter, I analyze each individual market and where they are. You can see the national average here at 0.8 in the cycle, and different markets below it and above it, but most of them in the growth phase. So as we go out to look for office properties to purchase and invest in, or to build in that market, we typically will stay within that expansionary phase. You can see a couple markets over the top, and I'll give you 2 good examples here. In Texas, you've got Austin just over the top, and you'll notice that it has a +1 after it. That means that it moved from position 11 in the second quarter of 2019 to position 12 in the third quarter. Someone may ask, why don't you have year-end data already? And as you know, real estate is a private marketplace. The data on what's happened doesn't come out till the end of the month after the end of a quarter. So I'll get my data on January 30th, run my models, and by mid-February, I'll have the new report out. So Austin moved up a little bit. It moved into the hypersupply phase, which means it its occupancies went down a little bit. Austin's one of the top markets for technology in the country right now. Lots of new jobs happening there, but the office developers have known that for a few years, and they're putting up just a little bit too much space. So it's a situation of a little more supply than demand. Houston, Texas, on the other hand, is just the opposite. As you know, we've had low oil prices for the past few years. So the oil industry has been laying people off, slowing down drilling and exploration. So it's a case of declining demand. They don't have a lot of new supply there, but the demand is falling off faster. And so it's even further down into the hypersupply phase. Note that each property type is different, and I'll use Denver, since I'm here in Denver, as a good example. Denver's right there at 0.8 along with the national average, right in the middle of the expansion phase, good job growth, supply just matching up with that new demand that's in the marketplace. If we look at industrial, you can see again, very similar cycle, following very similarly to the office, and therefore, the national economic cycles. A nice long equilibrium period in the 1990s for industrial, and the same thing happening today. A nice long occupancy equilibrium happening. Really strong growth because of the internet sales growing, and every retailer needing to be able to put things out and sell them through the internet. Fun fact, last year, Amazon leased 25% of all industrial space leased in the United States. That's how
25% in the United States.
25%, right. So you can see that, they're averaging 95% occupancy. Rents spiked up to as high as 7% growth. We expect that as we continue to add supply, for that to slow down back to kind of 3%, but that's still above the, inflation rate of 2% and GDP growth of 2%. So industrial's been honestly the best performing property type over the past few years, and most investors and researchers believe that that's going to continue for the next 2 or 3 years going forward. So very strong demand.
So we see the rent growth dropping there, occupancy staying pretty steady, but the rent growth dropping quite a bit.
I don't use the word dropping. It's still positive. It's decelerating. Instead of doing 70 miles an hour, today it's slowed down to 50 miles an hour. And over the next few years, it's going to slow down to 30 miles an hour. It's still moving forward. It's just going at a slower rate.
Okay. Great clarification.
And one of the things that I'm kind of coming to is the belief that, we're now in the longest expansionary phase that we've ever seen in the United States. We're more than 10 years of economic expansion. And a lot of economists say, well, it can't last more than 10 years. It's gotta end. But Australia is currently in its 28th year of economic expansion. So it is possible. And instead of booms and busts like we've had in the past, GDP growth of 5, 6, 7%, and then negative, 2% is something that is sustainable, I think, and could last for another decade, possibly. So we'll see. Unless there's a black swan event, who knows what's going to happen if we have a war, that kind of thing. So have to always throw in those caveats. So let's move on and look at industrial. You can see that majority of the markets are at the peak equilibrium level, balancing supply and demand really well. A number of markets where people have started to build speculative industrial space, so a little bit into the hypersupply phase, but most of those have been bouncing back and forth between that peak 0.11 and that next 0.12. Okay, we look at apartments, and you can see that apartment occupancies actually peaked back in 2004 and have been dropping off a little bit. Apartments are the easiest property type to get financed, hence let's build more. Demand is good. Anytime you build something new, you're pretty well guaranteed to fill it, because if you're having a hard time fill it, you just drop your rents to what older properties are charging, and people will move next door to be in a new building for the same price. So we've seen really strong rent growth in apartments as well. Same kind of high that we saw in industrial, around here around 6%. And slowing down to kind of the 2% level now, which is right at the level of inflation. You see a nice little pop here, and that came in 2019. and we expect that to slow because we're overbuilding by just a little bit. So kind of a lot of markets at that peak equilibrium, and then a lot of markets over the top. And if you look at Denver, as I was talking about before, Denver is even further over the top because we've been putting up just way more than we need here in Denver. Let's go to retail. This is probably the most surprising slide you'll see. Occupancy levels in retail are currently higher than they've been in any previous cycle. They're running 95.5%, whereas in previous cycles, they only made 94.5%. Everybody says, but wait a minute, retail's having problems. Stores are closing. Everybody's talking about closing stores and everything else. And the answer is yes, that's true. But again, this is demand and supply. There's still positive demand. Retail sales were up 18% over the previous year for Christmas this year. And internet sales went from 8 to 10% of all retail sales. So think about that for a moment. And there's still great demand for retail. Even though retail demand's only growing on a national average basis of around 1.5%, new supply is only growing at 1%. Because in many cases, when a retailer leaves a location, that location might be repurposed. We're taking some old big boxes and turning them into close-in warehouse for Amazon. We're taking, just had a former DU alum who's marketing an old small mall, if you will, outside of Denver as office space. So that space is being taken out of the retail supply and turned into something else. So good retail actually does well. Top malls are full, that kind of thing. And you can see there, though, that retail's rent growth is actually only running right now around 1%, so a little bit below inflation from that standpoint. So if we look at retail, most of the markets are near that peak equilibrium level, doing fine, but you got to pick the right stuff. Finally, let's look at hotels. Similar cycles in hotels. Millennials love travel. My kids travel a lot more than I did when I was their age. They're all in their 30s. But you can see here that we have some markets over the top where we're building just a little bit too much space as we go along. Denver being that too. Just read actually 2 days ago, 10 new major downtown hotels that are either have already started construction or have gotten a building permit. So we are adding lots of hotel space around the country at this point in time, and you got to be careful which market you invest in. So when you look at it, everything that I've talked about here is, I'm going to stop my share there. So everything that I've talked about so far is the income side of real estate. Occupancies go up, your income goes up. Rents go up, your income goes up. And so if you pick the right property types and the right markets, you're looking good. Things are going to do well. So having a good understanding of that's important. Those market cycle charts, by the way, we actually post on our University of Denver website at the Burns School. So just go to du.edu/Burns School, and you can get my quarterly market cycle reports.
Okay, so here's the simple truth. If you don't have private investors waiting on the sidelines right now, you're going to have a hard time closing your next syndication. Are you afraid to talk to investors? Do you feel you have a lack of credibility, or no one will take you seriously? Or what about your systems? Do you have anything set up yet? Well, if you know you can improve on getting in front of and influencing passive investors, then you should call my friend Adam Adams. Adam has a proven system for you to flip the script. Now, this is a 5-figure investment for you to take your business to the next level. I want to see you succeed, so I placed a link in the show notes for you to apply to work with the Adam Adams. And if you think you qualify and you know you're going to take action on what he teaches you, then scroll down, find the link, and take your money-raising abilities to the next level. Nice. Yeah, I'd love to put those in the show notes as well, or a link. I'll put a link there or something. That would be great.
Yep.
Because I know that a lot of people would love to go back and look at those. And I'd love for you to, if you could just focus on the apartments a little more, or dive in just a little more. I know the majority of the listeners are in the apartment business, and if we could talk about that cycle just a little more in depth, that would be amazing.
Sure. Well, like I say, there is great demand. We're looking at another 5 years of growth in apartment demand from millennials coming out of school, and again, either high school or college. And I'm sure most of your listeners probably have a college education. Only 25% of people in this country have a college education. So the other 75% come out of high school and typically wouldn't stay at home. Some probably still do, but a lot get kicked out. So they go get an apartment. The average age of a first-time home buyer in the United States is 36 years old. Think about that blue-collar worker who got out of high school, got a job, got a loan to buy their first car, started renting an apartment, spending everything that they make. Parents don't have enough money to help them. Then they get then they get married. And then they have kids, then they start saving money, and it takes them, from the age 18 till 36 to actually be able to, get that down payment to buy the house. So great demand from that standpoint. In addition, some older millennials like me are like, okay, I'm done having to manage a house, sell it, and let's just rent an apartment. So there's some growth in demand on the other end of that as well.
I've heard of that as well. I know like my grandparents, my grandfather's 99. They still live at home. They still, they wouldn't dare dream of moving out of that house if, in any way, form or fashion. However, like you said, I know lots also that are, retirement age. They're just like, I don't want anything to do with the yard anymore. I'm just going to find that apartment or, a place like that where everything's taken care of.
Right. Yeah. So, and of course, where do people move is another question. And I just joined a new subgroup of baby boomers called baby chasers. My winter home is here in Colorado near two sons. My other son, and I have 4 grandchildren in Minnesota. I just moved my summer home from New England to Minnesota to be near my grandkids. And there's already been research done that says, I'm going to buy a house of approximately 2,300 square feet. It's going to have a couple of bedrooms so that the grandchildren can stay. It's going to be near a park. It's going to have room for them to play in and that kind of stuff. So that's another new trend that we're seeing is, the millennials, when they retire, instead of going to Florida like my grandmother did, they're moving near their grandchildren.
Mm-hmm. Well, Glenn, where can, if we're looking up data like this, where should we look to get, the most accurate information? You're an expert in just research and especially the markets, and where can we, know that we're looking at accurate information?
Right. Well, if you've got investors that are really active, CoStar is probably the number one data source in the country for the 5 major property types. They actually own apartments.com. So they've got very detailed information in the apartment area. They just bought Smith Travel, which is the go-to data for hotels, and they've been doing this. Every broker that lists a property for rent lists it on CoStar. It's the multiple list service of the commercial real estate industry. Mm-hmm. If you're kind of a one-off investor, then you probably want to go talk to a commercial broker who has access to CoStar and get them to run a report for you. We use it at University of Denver. I use it to help the students learn it, because when they go out in the industry, they have a better chance of getting a job when they go, hey, I'm proficient in using CoStar.
Yeah, they're definitely going to be using it every day in the field.
Yeah.
A few questions, Glenn, before we run out of time. It's just amazing to have you on the show and just your expertise. But everybody's wondering, how are you prepared for this potential downturn?
We are, at my firm at Black Creek, we are buying high quality assets in great locations that can weather the downturn. We never try to, be able to sell and liquidate at any point in time. We want to sign longer term leases that will bridge you through the next downturn, so that when that lease comes due, the market's back, and doing well. So, location has always been kind of number one, and quality is number two. And then obviously upgrading your tenant quality would be number three. So those are probably the three key things that will help investors do that. I've had a number of people have said, hey, I think we're at the peak. And then a year or even two ago, they sold out and they're sitting on cash, and they missed a couple of years of additional upside.
So, how any recommendations of weathering that downturn, like you're talking about, how you all are prepared for that property to be able to weather the downturn?
Again, buying quality properties, taking care of your clients, your tenants, and getting the highest quality tenants you can get, I think are the two keys to weathering a downturn. Also, potentially lower leverage, so that if the income on the property does decline, you can still make your mortgage payments. I think most of the industry has lowered. It used to be in the direct world, 75% was kind of an average loan to value. Now, most banks won't even go above 60%. If you look at the REITs, both the non-traded and the public REITs, they all have leverage levels down in the 30% range. So they're very well insulated, from a cash flow problem.
Are you all considering bridge debt right now as well, or only agency debt, or any specific debt piece that you all are considering or won't consider at the time in the cycle?
Well, we as a large multi-billion-dollar company, we typically don't do bridge debt. We use both mortgages and lines of credit that the large firm can use. So not something that individual investors can do, but getting in income producing real estate, the typical is a 10-year is the maximum loan. And right now, with interest rates continuing to be low, locking in at that low rate for the full 10 years, I think is probably the best way to go.
And can I ask what markets you all are focused on?
Well, you just saw that I cover 54 markets and 5 property types, right? So that's 280 plus markets. And, we are deploying, millions of dollars every month. And so I can't say one market over another, give me a property type and that type of thing. And it's going to be, different for each property type. So that's why the cycle report helps. And, so we like a particular market. Now let's go find a property in that market. Well, then we got to determine the right submarket, and then whether or not that property has good quality, and then underwrite the tenants and the leases that are in it, and all the other things necessary. So there's no question that real estate has become a true profession. That's why every university in the country now pretty much has at least one real estate class, if not a real estate program. University of Wisconsin's the oldest in the country. University of Denver is the second oldest, started in 1934.
Wow.
So, we've been teaching this stuff for a long time.
And they don't teach us how to balance a checkbook in high school. Yeah. So, Glenn, what's a way that you all have recently improved your business that we could apply to ours?
I think, well, for us, the most important thing is finding and hiring and retaining good talent. The entire industry is in great need of high quality people. And, I just started my graduate real estate development class last night, and asking the students where they're from, what they're doing. The majority of them are in the real estate industry. A lot of people are 20% of my students have been engineers and have been working on, doing the engineering on a building, some of them on the construction side. And they go, hey, I want to be the developer now. I want to be the person that's making things happen. And so, they're looking to upgrade to get more responsibility, to be able to do more things, throwing out some golden handcuffs with ownership and things like that are some of the keys, I think, to making things go better. But right now, pretty much all the top companies are focused on finding and retaining talent. We get many, many people coming in asking us to, okay, can I have a career day? Come in and talk to your students. They will hire them for an internship, a paid internship. They used to be free. Now everybody's paying, interns. And I look at it as a way to try your boots on before you buy them. Mm-hmm. Hey, you had an intern for the last semester, quarter, whatever, and you liked them. Great. Offer them a job when they graduate so that they know they're coming right out into something that they like. They get to try you, you get to try them.
What's the number one thing that's contributed to your success?
Me?
Yes.
Hard work. Keeping my eyes open. I love what I do. I tell all my students, God gives everybody different gifts. Do that for a living, and it won't feel like work. If you enjoy what you're doing, it's highly probable you're going to be successful. So helping my students figure out what their God-given talents are. Some of them are really great people persons, so they're going to do brokerage, property management, that kind of thing. Some are really good technically with numbers, et cetera. They're going to be good in construction, finance, that kind of thing. So helping them figure that out is good. I think one of my keys to success is I've taken really complex stuff and been able to break it down and explain it easily, as I just did here with my cycle reports. I've got like 20,000 people that watch that cycle report every quarter.
I'll be watching it now that I know about it. So, what's a common theme you see across students that's maybe something that's holding them back from being successful in the real estate industry?
You mean individuals or my students?
Yeah, either way. Yeah, individuals, or as long as you've been in the industry, many people as you know. Either way, your students or just across your network.
What's holding people back is them not understanding everything well. And if I can, then I guess I'd correlate that to not having enough education. You got to keep learning and growing throughout your career, and joining up with a professional association to keep current on what's happening. My best friend in grad school, who actually introduced me to my wife 43 years ago, said the most important thing you ever learned was you got to circulate to percolate. If you're in the development industry and you're not a member of ULI, Berlin Land Institute, or a NAIOP, you're probably not connected with what's going on and on the, knowing what's happening currently in the marketplace, which means that you're behind the times.
Nice. Glenn, it's been a pleasure and honor to have you on the show, and somebody of your level of experience and expertise. And tell us again that link, though, to find your reports. Okay.
It is from Denver University. So it's du.edu/Burns, BURNS school.
Awesome.
And when you get to that page, on the top obviously is our programs, undergraduate, graduate, executive. Scroll to the bottom, and actually it's got 2 years worth of my cycle reports there for people to be able to pull up.
Okay, we'll have those in the show notes. So if listeners go to the website and go to this episode, you'll see a link there to what Glenn is referring to. But tell the listeners how they can possibly get in touch with you, Glenn, or how they can learn more about you as well.
My profile's on the University of Denver website, and my email address is there as well. It's my name. It's actually on the market cycle report, as a matter of fact. It's Glenn.Mueller, spelled Mueller @du.edu.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.